CMSINFO Systems is India's largest cash management company, now transitioning from physical cash logistics to a "digital banking infrastructure." This involves pivoting to AIoT and managed services, as seen with their Securens acquisition and massive SBI contract. Looking at the financial health for Q2 FY 2026, revenue was 609 crore, down 3% year-on-year, and net profit was 73 crore, down about 20%. This dip was mainly due to a consumption slowdown and fixed costs remaining high. The balance sheet remains pristine, with the company being debt-free and having significant cash reserves. Key strategic triggers include the SBI mega deal, which offers long-term revenue visibility, and the acquisition of Securens for AIoT and remote monitoring. Another trigger is the ATM refresh cycle, where banks are upgrading to cash recyclers, with CMS managing the end-to-end installation and software. However, there are red flags. A consumption slowdown directly impacts CMS's cash refill volume. UPI disruption has caused cash usage growth to plateau. Margin compression is also a concern if rising fuel and wage costs cannot be passed on to banks. In a peer comparison, CMS is safer than Radiant Cash, as it owns the infrastructure needed regardless of cash volume, making it less susceptible to UPI risk. Compared to SIS Limited, CMS has higher margins due to being tech-enabled and is a higher quality business trading at a lower valuation. As of January 8, 2026, the price ranges from 340 to 348 rupees, with a market cap of about 5,750 crores. The trend is currently bearish or oversold due to weak Q2 earnings, but the valuation is in the value zone, trading below historical averages, ignoring the high margin pivot. The future outlook suggests FY 2026 as the stabilization year, with management targeting 9% growth in services revenue in H2. FY 2027 is projected as the tech re-rating year. The catalyst for this re-rating is the managed services segment reaching 50% of total revenue, potentially shifting the stock's valuation from logistics to a tech stock. The final verdict is a strong buy for value investors, accumulating near 340 rupees based on zero debt, high ROCE, and the 10-year SBI contract. For growth investors, the recommendation is to wait for 1 quarter of double-digit revenue growth before entering. This stock is a defensive small cap with a free call option on its AI/tech success. If you found this stock review helpful, please like, share, and subscribe. Also, feel free to drop a comment below on the stock you would like to be reviewed next.